Ladies and gentlemen, thank you again for joining Where to Go for Income in a Low Yield World. We are thrilled to have a number of great experts joining us today. So let me introduce each one and tell you just a little bit about them. First, Aparna Chandak, Vice President of ETF Product and Strategy with McKinsey Investments. She's responsible for supporting the development and execution of the overall ETF business strategy, inclusive of product strategy and related high priority initiatives. She leads cross-functional engagement with key internal partners and fosters partnerships with external stakeholders. And please welcome Ben Gossick, CFA Vice President and Director at TD Asset Management. He joined TDAM in February 2009 and is currently co-manager of several North American and global equity and balanced mandates, including the TD Balanced Growth Fund, TD Diversified Monthly Income Fund, TD Dividend Growth Fund, and TD US Dividend Growth Fund. Previously, he held primary analyst responsibilities for the global banking, global technology, global media, and global telecom sectors. And also, I'm pleased to introduce Steve Hawkins, President and CEO of Horizons ETFs, a member of the Murray Asset Global Investments Group, where he is responsible for the day-to-day business and affairs of the firm. With more than 30 years of experience in the investment industry, Mr. Hawkins has been with Horizons ETFs for more than 12 years. He is partly responsible for the proliferation of ETFs in Canada, bringing many first-of-their-kind ETFs to market. Mr. Hawkins spearheaded the launch of the first family of actively managed ETFs in Canada, the world's first marijuana ETF, and the world's first global equity ETF driven by artificial intelligence. And please welcome our moderator, Sandra Martin, Editor-in-Chief of MoneySense. Informed by her rich and varied 20-plus years as a journalist and audience specialist, Sandra Martin is a multi-platform content strategist, an instructor at Ryerson University School of Journalism, and editor-in-chief of MoneySense. Under her leadership, in January 2020, MoneySense picked up a Silver Canadian Online Publishing Award in the Best Service Article or Series Consumer category. Ms. Martin's byline has appeared in the Globe and Mail, Cottage Life, and the National Post, among others. Sandra, esteemed panelists, thank you so much. The floor is yours.
Oh, thanks for having me, Chantel. Let's just dive right in because I know we want to cover a lot of ground in the next half hour. And we thought we would start by looking at where we have been. So traditionally, what role has income played in investors' portfolios and where have they been seeking it? What's changed since then? So why don't we start off with you, Purna?
Sure, Sandra. It's important to set the context, the historical view, and then look to whether that's sufficient enough in the market today and moving forward. So, historically, investors looking for income, particularly as you get older in life and you're looking for some consistent stream of income, have turned to GICs, have turned to Canadian savings bonds, Canada savings bonds in the market, or money market funds even, to get some certainty around income within a portfolio. And if we looked in the 1980s and rates at 18% in some cases that investors were able to pick up in these kinds of safer investment options, our world looks very, very different today, and increasingly so since the global financial crisis. Post-global financial crisis, we saw a lot of messaging, commentary, even central banks saying these are temporary measures. We're seeing rates at all-time lows through the global financial crisis or post that period, and it was to be a short-term measure. But what we've seen in the past several years, and most certainly highlighted this year as a result of the COVID pandemic, is that we are in an environment that is lower for longer. And it's not going to be improving in the near future in terms of the near 1% rates that we currently see in 5-year GICs at the major banks today. So retirees are living longer. We still have income needs, and the cost of living in some cases continues to rise. So how do you continue to pick up that income, knowing that that safety that you were quite used to in solutions like GICs or Canada Savings Bonds are not going to generate you a sufficient income to sustain that lifestyle? So investors today really need to take a different approach, need to look at alternatives to where to pick up that yield. It's not necessarily always a narrative of going further up the risk spectrum, but thinking about having exposures in your portfolio that you historically haven't turned to. But that relative safety is coming at a very high cost today, and that is the give up of the yield that investors have been used to in prior decades.
Right, and really key to consider that in real terms, that the safety, the places that we considered safe are no longer safe in real terms. We're actually losing money in real terms by sticking our money in GICs or even in some of the high interest savings accounts. So thank you for that, Per. Now let's move on, Steve, in terms of setting the context for our audience today. What can you add to that?
Well, I'm not a lot. I mean, Pernod hit the nail on the head with most of the content. I mean, but even this year, I mean, we've seen rates drop significantly from where they were at the start of the year. And for people that, want to hold cash, just sit in cash, sit in high interest savings products, as you mentioned, they're actually losing money on a real return basis, because when you take into the cost of inflation, which is over 1% per annum right now, people are actually losing money by investing in something like a CSB. They're only going to get 25 basis points. GSCs, they're only going to get 25 basis points. For high interest savings products, you might, if you are a very wealthy person, get 50, 75 basis points kind of thing. But even in all of those circumstances, it's costing you money to keep your money in cash. So what are you going to do with it? I know we're going to talk about lots of different alternatives right now, but really, people have to look at what is it costing me to keep money in cash from a security perspective, from my investment portfolio, the traditional 60-40 fixed income, maybe 10% of their fixed income is kept in cash, but that fixed income is not generating you any yield. 10 years are at the lowest they've been since the 1930s for the US Treasury, below 50 basis points. It's just a very, very different world. And, the one great thing I think that we all agree on is that interest rates are not going anywhere from here. They're not going back up very, very quickly. Inflation might go up, and it might even cost you more money to hold things in cash. So the world has definitely changed just even this year as it was compared to 10 years ago.
So something else that I would imagine are our investors' minds right now is, as if you've got a shorter time horizon, traditionally you would move out of your equity investments and into something like a GIC as it became closer to you needing to use that money. So an example that I think a lot of people would relate to is if you have been investing in equities for your child's RESP, your child nears 15th, 16th birthday, you want to start moving that out. So something that I would like to talk about in the course of this conversation is that still the right thing to do? Because if you've got a couple of years where money's just sitting and actually losing value in real terms, you're missing out on opportunities. Ben, as we set the context, what would you like to add to the conversation as we start off?
Yeah, so I mean, I want to touch upon your point about the timing aspect, which is, I think, is always so hard. But to tie back to what Steve was talking about in terms of today, where we're at these extreme lows, where in December of 2019, none of us would have predicted, 10-year below 1%, even in Canada and the US, that was unheard of. But back to what Perna was saying, this has been going on for quite a while. And what was really stark for us, we did an exercise where we looked at 1-year returns of GICs and compared it to inflation. I think we forget just how long ago was the financial crisis. You could get away with this strategy prior to 2008. You were okay to put your money in GICs, and you would end up ahead by a decent amount of inflation. So there was sort of this comfortableness that you could have. But this has been going on, I guess, since 2008, that because we had to go to ultra low rates to support the economy through the housing crisis, And now that we have to go even to more depth to support the economy to get through the virus, you have been falling behind, not just this year or the last year, but for over a decade. So clearly there is a challenge with GICs. Where we have found with timing, and to your point about, I have maybe I have a wedding coming up, maybe I want to buy a house. Now we all want second properties outside the city. Timing is always an issue for us. And if you look at even just this rally from March 23rd to today, if you missed on the best 5 days of the market, it's a stark difference what your total return outcome would be. So it's one thing, yes, we always think of cash as safety, but a lot of times cash is actually quite a risky asset.
Okay, so I think that sets us up really nicely for the next area that we wanted to cover, which is, we understand now that GICs, Canada Savings Bonds, some of those things that our parents might have relied on are not necessarily great options right now. Where should investors who are seeking seeking income, what are some of the best options for them right now? And we'll start with you, Steve.
Well, can I say what are not the best options first? So please, please don't buy a money market mutual fund. You are not only is it's not just sitting in cash, you're buying short-term bonds that are paying you, or costing the fund from a yield perspective, and then you're paying management fees on top of that to a fund provider. So no offense to the fund providers here on the call with me. We're an ETF only shop. But staying away from, I would say, what people have traditionally always thought about as safety from an investment vehicle of choice perspective is really they have to rethink things. And I think COVID has done a really nice job of actually giving people more time to actually look at their investments and make decisions about their own portfolios, where they're positioned, and actually learn a lot more about the investment process. And what they should be investing in. And so that's one really, really nice thing about the pandemic that has happened. We've seen hundreds of thousands of more TD brokerage accounts, discount brokerage accounts opened this year than we have traditionally any time in the past. Again, great things empowering investors. For us, investment vehicles of choice have always been ETFs. That's where we stand by. People have been putting a lot of money into, for us, like high interest savings account ETFs. Those have been one of the fastest selling segments in the past year and a half in the Canadian ETF industry. We've seen over $5 billion come into high interest savings ETFs now. So that's been a very, very nice vehicle. They're generally all paying in the same yield range of 75 basis points, very, very small management fees. But very simple product from that perspective. People are still looking for bonds from a fixed income portfolio, though we're suggesting, without giving direct advice, that the traditional 60-40 portfolio is now dead. You really need to have a higher allocation to equities, which can include some quasi securities in there, like preferred shares and things like that as well. Preferred share market in Canada is actually doing very, very well. It had a little bit of a hiccup during the crisis in March, but these are securities that are generally yielding above 5, close to 6% on an aggregate basis. So Canadian preferred shares are a great marketplace now to determine yield, but people are chasing credit. And I think credit is where, the more credit risk that you're willing to take on in your portfolio, the better the yield you're going to be doing. So in the Canadian preferred share market, it's these are high ranking issuers, traditionally the banks and things like that, that you can get these preferred shares, which rank high in the capital structure of the company. They're not bonds themselves, but if you're going into the bond space, it's really moving away from governments and short-term credit securities into longer duration, and you're taking more credit risk. So you're going into the below investment grade market. Investment grade bonds, in just this year have dropped significantly from an average rate perspective. You're, going from, 5% to 1%. In the investment grade bond market, it started at 5%, below investment grade market. It started at 5% and it's increased to 6% so far this year. So people are taking more credit risk with respect to their portfolios to chase that yield that they still want. To everybody, what we agree on, there's still a significant part of the investment environment in Canada that people need income to generate out of their portfolio to pay their day-to-day bills. And as they get later on in their life, as you mentioned, they want to move away from risky equity assets and more fixed income. But when they're in the fixed income now, you really can't be just stuck to the traditional government bonds or CSBs or money markets and things like that. You really have to look for where you can actually generate yield, where you're not losing money.
Okay, thanks for that, Steve. Ben, do you want to speak to that? And I'm wondering if the group could also ponder an aspect of that, in that because Canadians are living longer, do we now think about, retirement used to be, okay, now I'm going to reap what I sowed earlier. Do we continue to have an active investing strategy going forward? Ben, do you want to take that and add anything you wanted to Steve's comments?
Yeah, so I'm an active portfolio manager. So yes, I would preach active, and I think Steve did a great job identifying the key issue here, which is when central banks come in to support the economy with quantitative easing, which is what we saw with the financial crisis. They take the market for treasuries and they force everyone up the risk curve. So if you want yield, as Steve said, you have to look into corporate bonds. You have to look into higher yielding securities. So I would say you do need skilled managers to help you in those areas. I manage a lot of equity portfolios, ETFs, mutual funds. I'd say for us in those mandates, you could look at the market and say dividend yields are low, maybe they're 2%. But even in a global pandemic, we focus on companies that grow their dividend. So they have competitive advantages. They still have ability to grow in these markets, even though the global economy isn't growing that much. And when I look at our portfolios, on average, the checks that we're receiving from our dividends, even in this year, with rates this low, have grown by 10%, which is far in excess of cost of living. So I think Steve identified all the opportunities that people could seek in the fixed income market. I believe there's still lots of opportunities in the equity market, and particularly dividend growers. And then even for our portfolios, we still hold cash because we're always looking for opportunities to buy stocks. But what we do is we write a lot of puts. And this, for us, is our way of getting paid to buy stocks at lower prices. And you always have to set aside cash to do this. And our strategies for the last couple of years have always yielded at least 15% on these put writing strategies. So there are lots of opportunities for investors to seek in this area, even though yields are so ultra low.
All right, great. Thanks, Ben. Perna, anything to add?
Yeah, so perhaps summarizing from both of our other panelists as well, we share similar thoughts. So just on fixed income, given the current environment and what we see in the foreseeable future, investors can really do two things. Extend your term out and extend your investment period, essentially. And so that, coupled with the fact that you're living longer, in any case, likely aligns in terms of how you should be thinking about your fixed income exposures. So high yield, great place to be. Think about active management here. There are passive ETFs, there's active ETFs in the market, but that ability for an active manager to really pick and choose the right risk or opportunities within the portfolio can pay off in periods that we see in the market today. We're fortunate in this period of time with the amount of product we have on offer for investors in Canada. With 900 plus tickers, there are a lot of solutions to choose from, but ultimately that work sits with you to do that due diligence in a number of different index and active areas within fixed income, lots of ETFs on offer. So I would highly stress that you do that due dil, because there's a lot of great solutions. Floating rate loans is another great area for investors in terms of picking up some yield. You're taking on a bit more risk, but you're getting a significant pickup in yield. So again, lots of solutions on offer, active and passive. Take your pick, and if you go down the active route, you're likely getting more exciting opportunities with that overlay of a manager actually managing the risk return framework for you. Emerging market debt is another area that we feel quite passionate about, both hard currency and local currency government debt in emerging markets. If you consider the risk return framework for these segments of the market, there's still very good opportunity to pick up yield. Emerging market local currency and hard currency sit anywhere between 4 to 5% in yield today, a meaningful pickup from developed markets. So there continues to be a lot of investment in China and India and other emerging market countries by their governments in infrastructure and other spending. You can benefit from getting that exposure through fixed income solutions as well. We talked about inflation briefly. Think about how your portfolio is prepared or not for inflation shocks that may come in the next year or two, and solutions that offer you TIPS exposure, treasury inflation protected securities, come at a very low cost, available in the Canadian market, also in the US if you have US accounts, of course, but that can help hedge some of your portfolio risk to inflation. And finally, we also feel quite strongly about high quality companies and dividend pickup opportunities in your equity portion of your portfolio. So don't, summarizing again what our panelists have said, don't just look at your fixed income sleeve as a sleeve generating your income. Equity has to increasingly play a bigger role in your income pickup. And by looking at solutions that deliver you a basket of higher quality companies, perhaps managed for volatility as well, can really help with that. So number of solutions on offer, as I said, in the Canadian market, and tax benefits to you in certain account types to actually shop in Canada. We stress that quite heavily. You don't need to cross the border to buy a lot of these solutions. You've got a lot on offer here in Canada for that.
All right, lots and lots of options. We have a few questions right now, so I will take a step out of our the areas that we wanted to cover and leave it open to all three of you to jump in with the answers. First question, and Perna, you touched on the inflation aspect of this. First question is, do you foresee taxes and inflation going up given the COVID-19 spending by the Canadian government, thus creating deficit?
We do anticipate inflation being a key theme in the next 12 to 18 months. In a number of our active portfolios, for instance, we do utilize our own QTIP, which is our US Treasury Inflation Protection Securities ETF in Canada. Our active managers feel strongly in having that exposure in the portfolios. And ultimately, what will hurt you the most is the surprise inflation. You're not seeing it coming. What you're hearing from central banks in the US, Canada, globally, is that they want inflation to ride over that sort of 2% midpoint that we've historically seen in the past decade or two. And central banks are more than willing to let that ride. And they've come out vocally saying that. And so we do intend to see inflation impact investors. And I would suggest that you take a hard look at whether you have active portfolio exposure or passive. How is your portfolio prepped for that potential shock that is likely to come in the next 12 to 18 months?
Thanks for that. So there are some rumblings too. Sorry, just wanted to pop this in there because this is something that we hear at Money Sense. Some questions about whether we'll see an increase in the capital gains tax.
Yeah, so I think for the individual, I think that's still an open discussion, whether they adjust the taxes for dividend income, capital gains. Clearly that was on the table in the US, and if the Senate holds Republican, then that's been pulled off the table. But government, especially the federal government, has had to take out a big loan to provide a bridge to the other side of this coronavirus crisis. And at some point, there'll be a bill to pay. And it probably would mean higher taxes. I still think there is an open debate on inflation. We saw a lot of a stimulus to get us through the financial crisis that didn't lead to inflation. And I'd say there's been a lot of spending on both central bank and government, so fiscal side, that would give you the feeling that there could be inflation. The only thing that I think could give us that sort of push down and tamper in inflation is that we've also seen 5-year pull forward of technology trends. And these are very strongly disinflationary. So there is, I think, still a healthy debate on where we'll see inflation, but sadly, I do feel that taxes are around the corner.
All right. Next question. I'm just mindful of time, and I know there's another section we want to discuss. How do each of you feel about Canadian corporate bonds, both investment grade and high yield corporates? The question asker says, should various monthly income funds, whether a fund or ETF, be held in registered account or non-registered account, given diversity of income from capital gains, dividends, and interest?
That's a long question. Well, I'll start anyway. But I mean, we've seen for investment grade bonds, we've seen yields generally drop over the past year from, well into the 3s, 3.5 and above, to now below 2. So unfortunate for the investment grade bond market. They haven't had to. It hasn't been as expensive for them to raise capital that way. The investment grade, the below investment grade market is definitely differently, as we've seen yields increase there. And for the non-investment grade issuers, it's costing them more money to borrow money out in the system, and we've seen the yields increase up to the 6% range. When you're dealing with back to Perna's point, I think it is a very, very important point. When it comes to managing the fixed income part of your portfolio, if you're going to own fixed income in your portfolio, the Canadian and the US fixed income market is an extremely complicated one with respect to all the underlying issuers, all of the different nuances with respect to the underlying bonds, the convertibility, all the different aspects for them. And I think it is extremely important that people use active managers for the purposes of managing the fixed income portfolio, especially when you're dealing with investment grade bonds or below investment grade bonds or preferred shares or anything from a fixed income perspective. Active management is truly important, and one of the reasons why we launched a family of actively managed fixed income funds. When you are with certain funds out there, they are from a corporate bond or from a high yield bond perspective, you're going to generate this year probably potentially a significant amount of capital gains out of the portfolios. There was a huge disconnect in the fixed income marketplace, which took place in April this year, March and April this year. The fixed income market has come back very significantly since then. There was a lot of trading opportunities for active managers. They were generating a lot of capital gains inside those portfolios. So not just the yield, but so we could, if you're owning these types of funds outside of a registered account, you could be subject to not only some nice income that you would have generated this year, but you're going to see some potentially nice capital gains as well. If you'd held them prior to this year, then potentially you could be flat this year, maybe down a little bit, maybe up a little, and you won't necessarily have to worry about capital gains. But if you just held your own physical bonds, but through the funds themselves, I think they're doing a very, very there was a lot of activity going on in the fixed income corporate world in Canada, especially. One thing's right now, you have to be wary of the fact that with all corporate bonds out there, really, it's being backstopped by the U.S. government, who has weighed into the investment grade and even below investment grade marketplace in the U.S., and it is supporting all of North American corporate issuers from a fixed income perspective right now, because they're out there buying more bonds. And to Ben's point earlier, somebody is writing a check right now, and at some point in time, that bill is going to come, and yes, taxes are going to go up. But from my perspective, inflation is going up and taxes are going up. But fixed income, I think, is a great place to be still right now. We've seen credit spreads narrow significantly since the government's weighed in to the investment grade market in May, April, May this year. So credit spreads have come in pretty significantly. Yields have continued to go up, which is very, very nice. But to Perna's point earlier, it is very, very important to own active management in this space. So looking at the right fund or ETF that meets the goals that you are looking for, and whether you hold it in a registered or non-registered account is really up to you and your personal circumstances. Do you need income? Are you where you are from a tax perspective? In the longevity of your investment portfolio. So there's a lot of different nuances there. So it's very, very impossible for us to sort of provide advice to that part of the question. But the products themselves, there's a lot of different products out there. a lot of different possibilities, and it might just end up being whose logo you like the colors the most of from a product producer perspective, because a lot of the funds are very, very comparable, but you do need to know your product, you need to know your issuers, you need to know what fees you're paying at the end of the day to bring that exposure into your investment portfolio.
All right. And speaking of fees and understanding the effective fees on your overall returns over the long run, I know we wanted to talk about how investors can generate income using ETFs a little more in a little bit more of a granular way. Ben, do you want to start this one off?
Yeah, so I wanted to talk about one of the ETFs that I launched last year, which is the TD Active Global Enhanced Dividend ETF. And it touches on a lot of the themes that we were addressing, which is there's a lack of income in the market. But because there's a lack of income, and Sandra, you touched upon the part that we live longer, I actually think you need income and growth. So you're getting lower yields, so that nest egg that you've been accumulating for all these years is not delivering when those your GICs, your bonds reset. So you actually need more of that money to derive some income. So we own secular growing equities that are dividend growers, non-dividend payers. And then we layer in active call writing and put writing to sort of give you this sort of 4+%. But I think investors need income, but they need growth. And I find there's a lot of products out there that are either all growth or all income. And sometimes that income is at the expense of growth. So to Steve's point, due diligence matters. But there is a tremendous amount of income products. It's just important that people do their work to know where that income is coming from. And make sure it's not coming at the expense of their growth.
All right, Perna, anything you wanted to add to that?
Yeah, so going back to the active piece, we've had active fixed income in the Canadian market in ETFs since 2016. We have a solution that is an ETF of ETF vehicle. So it takes low-cost building blocks and uses active asset allocation from our portfolio management team to put those pieces together. 25 basis points, ticker MGAB, MGAB. It's a great solution to get that income without having to do the work on each of those 11 underlying building blocks. You're doing the work on the overall, doing the analysis on the overall strategy. So that's a great solution. That's one of many in the marketplace that give you this sort of solutions-oriented approach where you're getting that active manager's view on asset allocation. But as I mentioned, look at high yield, particularly actively managed high yield like our MHYB. Look at emerging market debt. Even if it's a 5% sliver of your fixed income portfolio, that can add some good yield. So hard currency, local currency, QEBH, QEBL, those are some really great options. And then certainly on the income, equity income side, dividend oriented strategies with that high quality tilt. So something like MDVD is a great solution.
All right, thanks. And with not much time to go, Steve, did you want to add anything to that?
Yeah, I mean, I just want to expand a little bit further on Ben's point. I mean, I think, in this marketplace as well, growth is with the longevity of the investor's portfolio and their need for continued income, they do have to grow the portfolio to gain that income. And to Ben's point, again, when we're doing anything from a balanced portfolio perspective, we're overweighting equities now from a 70-30 perspective. And what we're using in the fixed income portion, we are, not only staying in Canada, but we're going outside of Canada to the developed markets, to the emerging markets, not just the US market as well. But covered calls are an extremely important tool in this marketplace, especially in the equity side of your portfolio, because one, they continue to provide some growth. They continue to provide a fantastic availability for yield, additional yield in portfolio. You can own a bank covered call ETF and be earning, just a 5% yield just from the Canadian banks, but then you have a covered call overlay and you could be earning another 5% on top of that. You might be taking away some of the positive upside potential out of that portfolio, but you're also reducing substantially the risk of return in that portfolio. If you see a market sell-off, or if you're concerned about the markets as we are right now, and maybe everybody thinks that they might be at elevated levels, but owning a covered call portfolio is a great risk return portfolio. Gives you the ability for continued growth, gives you greater income on an overall basis. And to Perna's point, you can actually use them as an asset allocation tools, because you can rotate in and out of different sectors with respect to covered calls. So you can have broad market, you can have S&P 500, you can have TSX 60 covered calls, but then you can get into financials, you can get into just energy stocks, you can get into just gold stocks for us. We actually even have a covered call ETF just on gold itself. So, gold's been a great seller this year, but mostly from a capital protection perspective in a portfolio. And people don't think that gold can ever generate yield for you. It's only there because it never pays a dividend. But if you buy a gold covered call ETF, you're one getting the growth of gold, but you're also getting a yield generated from gold. There's a great liquidity for underlying options for gold itself. And owning like HGY, which is our gold covered call ETF, it gives you that exposure to gold and gives you a nice actually yield based on gold as well.
All right, thanks. We've got a couple questions asking for some clarification. Ben, one of the viewers has asked you to repeat the name of the fund you mentioned. Yeah, so it's the TD Active Global Enhanced Dividend ETF. So the ticker is TGED. And then we also launched a US specific one. So just stocks that trade on US exchanges, and that's TUED. That's the TD Active Global Enhanced. That's TUED, TD Active US Enhanced Dividend ETF. And so again, our goal there is just own dividend growers, own non-dividend payers. And as Steve said with the gold example, owning Amazon is great, but it doesn't pay you an income. And writing calls on Amazon or on other exciting stocks like ServiceNow, you can create synthetic income streams, which is exciting. But yeah, income is extremely important. Growth is going to be very important, but not talked a lot about. Okay, thanks. And one last point of clarification directed to Perna. What ends up being the fee for the ETF on an ETF?
So I guess that's in reference to my mention of MGAB. It's a 25 basis point management fee. There's no duplication of fees from any of the underlying ETFs. So it's 25 basis points plus taxes, essentially getting you to your all-in cost for that ETF.
All right, so I'm told we have time for maybe one more question. Looking at, here's the question. As more and more people move into high yield corporate bonds, won't their yields start to come down via simple supply and demand? So please jump in.
Sure, I'll take that one. But yes, on a simple basis like that, if the corporate issuers can issue debt and there's a lot of more buyers, they're not going to pay a higher coupon on that date if they don't have to. So as that supply demand changes, then yes, yields could come down in the high yield marketplace. We really have not seen that happen. We definitely won't see that happen anytime in the near future from my perspective. How that has changed though is like with respect to the bank network and this new security called LRCNs, limited recourse notes that they've started issuing as of this year. And those notes themselves have actually been, very well bought up in the corporate world in Canada. The banks have been able to sell them easily, and they've been able to sell them at lower yields than what they've been traditionally issuing their preferred shares at. So one, the banks are able to generate these new sort of quasi fixed income securities. They're able to do them at lower rates because there's been a very, very active buyer's market for them. And what that is doing is doing very well for the preferred share marketplace because there's less supply of preferred shares out there. So to the point about even corporate bonds, preferred shares, which are being issued by corporate issuers, are less. There's a less universe available. That's putting upward pressure on the preferred share marketplace because all of the rate resets that are out there already have great yields on them, and those are going to come down when they reset at a later point in time. But LRCNs, which is this new sort of asset class for Canadian banks out there, is doing great for I would say the corporate bond market as well as the preferred share marketplace.
All right, thanks so much. We are out of time. I really feel like we could have talked for a lot longer, but I want to thank each of our panelists today, Perna Shandak from Mackenzie Investments, Steve Hawkins from Horizons, Ben Gossick from TD Asset Management. I've learned a lot today, and I know that our viewers did as well. So thank you for joining us.
Thank you.
For having us.
Sandra, thanks for having us.